The obstacles that we can see today must not stop us.
When the news broke in Ouagadougou, it wasn't just another signing ceremony. It was a geopolitical shockwave. Oman, a Gulf monarchy long known for its oil wealth, had just entered into a historic multi-billion-dollar partnership with Burkina Faso. But this was not just about gold. It was about sovereignty, food security, and the rewriting of Africa's place in the global economy. The agreement signed included 3 pillars: a joint venture in gold mining, a multi-sector investment partnership, and agricultural projects centered on rice and strategic crops. The signatories were no small figures. Representing Oman was Abdul Salam Mohammed Al-Murshidi, chairman of the Oman Investment Authority, a sovereign wealth fund that manages tens of billions of dollars. Representing Burkina Faso was Karamoko Jean-Marie Traoré, Minister of Foreign Affairs, alongside leaders of SOPA-MIB, the state-owned mining participation company, and the Ministry of Agriculture. The symbolism was undeniable. A Gulf state was planting a stake in the heart of Africa. Not through colonial-style loans, not through Western aid rhetoric, but through shared ownership and partnership. Across the continent, the reverberations were instant. In Bamako, commentators asked whether Mali could strike a similar deal. In Niamey, observers saw parallels with Niger's defiance of France over uranium. Across the Sahel, the message was clear. Burkina Faso had opened a new door, and Oman had walked through it. This wasn't an IMF loan loaded with conditions. It wasn't Western aid dressed in humanitarian slogans. It was hard capital flowing into Africa, on African terms. A deal born of sovereignty for Burkina Faso. The timing couldn't be more significant. In the past year, the government under Captain Ibrahim Traoré has pushed aggressively for resource sovereignty. It nationalized stakes in key gold operations, demanded that foreign firms refine more of their output locally, and created SOPA-MIB to give the state a decisive role in the gold sector. These moves rattled Western investors. But for the people of Burkina Faso, long excluded from the wealth beneath their feet, it was a cause for celebration. Now came Oman, stepping into this sovereignty-first framework. The gold deal with Oman's Minerals Development Oman MDO wasn't a concession, it was a joint venture. And that phrase makes all the difference. For decades, foreign miners treated Burkina Faso as a quarry. They dug, they exported, they pocketed the profits. Local communities were left with polluted water, eroded land, and little to show for it. The state collected scraps and royalties while foreign shareholders in Paris, Toronto, and Sydney boasted of record dividends. But this time, things are different. SOPA-MIB will sit across the table from MDO as an equal. The Burkinabe state won't just be a tax collector, it will be a co-owner, a shareholder, a decision-maker. That means African voices will now shape policies on safety standards, environmental protection, community engagement, and profit distribution. Gold, once the symbol of exploitation, is being rewritten into a symbol of co-ownership. And the changes are not only on paper. The government has already begun constructing its first gold refinery, with capacity to process 400 kilograms per day. Part of the gold extracted under this Oman partnership will be refined at home, not exported raw. This means jobs for Burkinabe workers, skills for Burkinabe engineers, and value staying within Burkina Faso. For decades, gold left the country in raw form while people lived in poverty. Today, the shift means gold will also build schools, power infrastructure, and fund development. No wonder Western investors are nervous. They call it resource nationalism. But for the people of Burkina Faso, it is simply justice. Agriculture. From gold to grain, yet sovereignty cannot rest on gold alone. Mines may fill treasuries, but they cannot fill stomachs. That is why the second pillar of the Oman-Burkina Faso deal, agriculture, is perhaps even more revolutionary. Oman pledged to invest in large-scale agricultural projects, with rice cultivation at the center alongside cereals like maize and millet. At first glance, this may sound less dramatic than gold, but in truth, it strikes at the heart of Africa's dependency trap. Food. Burkina Faso, like much of the Sahel, has lived for decades under food insecurity. Despite fertile land, the country has relied on imported rice to feed its people. Every global shock, whether the war in Ukraine or disruptions in Asian grain markets, sent food prices soaring in Ouagadougou. Riots over bread and rice prices were not uncommon. Food imports drained foreign reserves and left the nation vulnerable. The Oman deal targets this weakness head-on. By investing in irrigation, mechanization, and processing, it aims to make Burkina Faso self-sufficient in rice and strategic crops. This is about more than farming. It is about stability. In Burkina Faso, when rice is affordable, peace is secure. When rice prices spike, unrest brews. To control rice production is to control political legitimacy. The deal envisions modern harvesters, silos to cut post-harvest losses, and mills to turn local crops into flour and packaged foods. This would not only feed Burkina Faso, but potentially turn it into a supplier for neighboring countries. For rural communities, it means jobs and incomes. For urban families, it means affordable food. For the state, it means less dependency on volatile imports. For Oman, the strategy is equally clear. The Gulf states import over 80% of their food. By investing in African agriculture, Oman secures alternative supply lines for the future. It is a win-win. Africa gains food sovereignty, Oman gains food security. Beyond gold and grain, transformation, the third pillar of the agreement, is the most ambitious of all. A comprehensive multi-sector investment partnership. This goes beyond mines and fields. It includes energy, infrastructure, and industry, the arteries of a modern economy. Why does this matter? Because Africa has long been locked into a colonial economic model. Export raw materials, import finished goods. Export cotton, import textiles. Export cocoa, import chocolate. Export gold, import jewelry. This cycle drained wealth and stunted industrial growth. Burkina Faso wants to break it, and Oman has agreed to help. This partnership aims to fund power plants to end crippling blackouts, build roads and logistics to connect farms and markets, and support industries that process raw materials into finished goods locally. Imagine Burkinabe cotton spun into textiles within the country, Burkinabe cereals processed into packaged food, Burkinabe gold turned into jewelry that carries the label, "Made in Burkina Faso." That is the vision. Western analysts dismiss such ambitions as risky or unrealistic. But for the people of the Sahel, risk is continuing the old system that delivered poverty and dependency. Real risk is leaving things unchanged. Why Oman? The natural question arises, why Oman? Why would a Gulf state thousands of kilometers away take such a gamble in the Sahel? The answer lies in Muscat's own story. For decades, Oman's economy depended heavily on oil. But oil prices rise and fall, and Oman has long sought to diversify. That is why it created the Oman Investment Authority, tasked with spreading wealth across sectors and regions. For years, Oman invested in Europe, Asia, and North America. But those markets are saturated, their returns are modest, and their politics are volatile. Africa, by contrast, offers something different: youth, resources, growth potential. For Oman, Burkina Faso represents both opportunity and alignment. Opportunity in resources and agriculture, alignment in sovereignty. By partnering with a nation demanding fair terms and co-ownership, Oman positions itself not as a colonial player, but as a pioneer in South-South cooperation. The bigger picture: the Oman-Burkina Faso deal is part of a larger continental shift. In Niger, Russia is partnering on nuclear ambitions. In Mali, Turkey is supporting defense industries. Across the Sahel, France has been pushed out, its influence crumbling. Western dominance is breaking and new alliances are forming. The message is consistent. Africa is no longer waiting for permission. It is setting its own terms. For Burkina Faso, the symbolism is powerful. A nation once forced to beg for aid is now signing billion-dollar agreements on its own terms. For Oman, the partnership is a bet that Africa's rise is real, and that respect for sovereignty is the surest way to secure lasting partnerships. A new era for Africa. What began in Ouagadougou with 3 agreements is bigger than Burkina Faso or Oman. It is about a shift in global power. If Oman can accept joint ventures in gold, rice-focused agriculture, and infrastructure, what stops other Gulf states, Saudi Arabia, Qatar, the UAE, from doing the same? Will China adapt its model to Africa's sovereignty-first approach? Will Western powers finally recognize that the old rules no longer apply? Africa is not a quarry. It is not a charity case. It is the arena where the 21st century's global order is being reshaped. The Oman-Burkina Faso agreements are more than contracts. They are a declaration that the age of dependency is ending, and the age of partnership is beginning. For the people of Burkina Faso, the question is clear. Will this gold finally enrich Burkinabe families instead of outsiders? Will food sovereignty through rice farming finally end hunger? One thing is certain. Africa is no longer waiting to be told what it can or cannot do. It is telling the world what it will do. And Oman, by stepping into this moment, has chosen to stand on the side of Africa's awakening.